Good morning. Welcome to the weekly market wrap up. The Indian equity markets ended the week in the red with the Nifty sliding 0.2% and the Sensex going down 0.48% for the week. The small and the mid cap indices continued to further extend their losses and end the week in red. The Indian CPI inflation numbers were in the week. The Indian CPI inflation came in at 5.7% from 5.9% the month before, mainly due to the decline in food prices, especially vegetables. The US CPI index also fell 0.1% in December and the inflation slowed down to 6.5%. However, the core US CPI inflation was slightly up 0.3% and ended at 5.7%. The headline rate in inflation in US is at its lowest since late 2021, and we can therefore expect the Federal Reserve will soon be starting to stop the rising interest rates. The IIP index, or the Indian Industrial Production Index, numbers for November registered a strong recovery on the sequential basis. The manufacturing industry saw a great rebound on sequential basis. The capital and infrastructure goods industry saw great traction during December, corroborating with the story that there is a rising capex by enterprises. Consumer durables and non-durables output also saw a great recovery on sequential basis after declining for 3 consecutive months. Electricity, on the other hand, remains well above the seasonality trend. Coming to the IT results, the top 3 IT companies announced their Q3 results during the week gone by. While TCS reported a dull result with a cautious eye on the near-term demand, Infosys reported a mixed financial performance for the quarter with a revenue guidance revision. Coming to the TCS results, the revenue growth in TCS was mainly led by strong performance in the retail and the CPG vertical. There was a sequential improvement in EBIT margins of about 50 bips on quarter basis, led mainly by improving employee pyramid and other efficiency measures carried out. Infosys reported a constant currency revenue growth of 2.4%, led by manufacturing and energy and utilities segment. Infosys raised its FY23 revenue guidance from 15 or 16% to 16 to 16.5%, while it retained its aim of achieving the lower end of its the EBIT margin guidance of 21 to 22%. The US markets continue to be stronger and better performing for Infosys than Europe. Quarterly deal wins were healthy and were up 30.4% quarter on quarter, and Infi saw a TCV gain being the strongest in the last 8 quarters, with 36% of the net new deals coming in on an average of 49% over the last 6 quarters. The employee attrition remained high as LTM attrition declined by 20 bips to 21.3%. HCL Tech also reported a strong sequential performance. Both revenue and operating margins beat the street estimates. The service segment grew by 2.2% on the constant currency terms, while the product and the platform segment or the software segment grew by 30.5% on the quarter terms. LTM attrition was down 210 bips on quarter basis to 23.8%, while the revenue growth guidance has been changed from 13.5 to 14% range and has been increased, while it narrowed down its EBIT margin guidance to 18 to 18.5%. Coming to the synopsis, the long-term demand story in the IT segment remains strong, mainly led by cloud adoption and data analytics across enterprises. Commentary demand has been consistent, with companies seeing BFSI, retail, telecom, high-tech segments impacted more than any other verticals. There are visible signs of deal slowdown and deal conversion on account of economic growth slowdown and macroeconomic concerns in US and Europe. Moderation in order book and sticky attrition remain the key downside risks to revenue and the EBIT margins. Our long-term trend analysis suggests that the performance and the stock valuations are more closely tied to the sales growth rather than the earnings upgrade of the company. So that will be a key monitorable in the coming quarters. Valuations, however, have recouped from their September lows. except Wipro, all 5 companies are trading at their 5-year median PE ratios. We prefer Infosys over TCS. We believe that the recent organizational changes at TCS would drive near-term demand, near-term underperformance rather, for this stock in our view. We believe that TCS will narrow down its valuation premium to Infosys, and that's why we prefer having Infosys over TCS in our portfolio due to its acceleration in its growth strategy and due to industry leading capabilities. That's it from the weekly market wrap up. Thank you.